Start with the information that we have on the board, the date, the explanation, the units, the cost, and the total cost. You don't need to write this down again. Okay, first thing I'm going to do is get my totals for my units. 5, 10, 4. And the total for my cost. 5, 11, 5, 6, 13, 19, 5, 4, 8. 15,510 total cost for 144 units. Okay. Who can tell me how many units we sold this month? 121. Where did we get that from? It just says it right there. Half of this class is making sure you read the information so you know what you're looking for. Okay? So if we had in total 144 and we sold 121, that means we have how many remaining? Okay. 23. All right. So the first thing it asks us to do is compute the ending inventory. It's September 30th, cost of goods sold, and they want us to use LIFO, FIFO, and the average cost method. All right. We get the remaining inventory, and we're going to go ahead and we're going to calculate the ending inventory first. Okay. If we go by FIFO, and we're trying to calculate your ending inventory, we're going to take our ending inventory amount, okay, and we're going to compare it to all the purchases. So if we're going FIFO ending inventory, we start at the bottom and work our way up, okay? So I'm comparing 23 and 50. If I know this 50 is at 112, okay, I say to myself, well, which one is greater? Well, the 50 is greater, so I can only take 23, or I've covered the entire 23, however you think about it. So I do 23 times 112, and that gives me something like 2576. Okay? And that is my ending inventory for FIFO. All right. If I know I have a total cost of 15,510 and I have an ending inventory of 2576, then that means my cost of goods sold is the difference. Does everybody understand how I got these numbers? Clear on what I did? Okay, we are doing FIFO, cost of goods sold, ending inventory. When we have 121 sold versus 23 remaining, it's easier to account for the 23. So I said, let me just do that. Well, if I know I have 23 remaining, I'm going to go to my last purchase and say I have 50. 50 is more than enough to cover the 23. So that entire 23 costs $112. Okay? I get that ending inventory, I subtract that from my total cost, and that gives me the cost of goods sold. Okay? All right. So the next method is LIFO, ending inventory. Very much similar. Okay. So LIFO, ending inventory, we're going to do the same thing. We have the same 23 units ending inventory. So we have 23 units we need to account for. Whereas with FIFO, we started at the bottom. With LIFO, we're going to start at the top. Okay? So we have 25 units here that we purchased at 100. Okay? Those 25 units are more than enough to cover that 23. So I only need to cover this 23 at $100. And I've covered everything. So 23 times 100 will give me 2,300. That is my ending inventory LIFO. Okay. And if I subtract the 2,300 from my 15,510, I get 13,210 is my cost of goods sold. Okay. Any questions on LIFO, FIFO yet? Everybody good?
Actually, like questions C and D, just like how do you know which one's gonna have the highest income?
Oh, okay. We're gonna get once we get there, I got you. Okay. So now we've got FIFO, we've got LIFO, and then the last one that we're going to do is weighted average unit cost, or average unit cost. Okay? To get your average unit cost, you get an average cost, which is equal to your total cost divided by your total units. Okay? So you get a total cost of 15,510. You have units of 144. Okay? And that gives you a cost, an average cost of about $107.70 per unit. Okay? And if I want to get my ending inventory, I multiply it by what? I will multiply the 107.7 by how much? 23. The number I have units remaining in my ending inventory. So if I want ending inventory, I do 107.70 times 23. And that will give me approximately okay. And I can still do the same method of 15,510 minus the 2477. I'm sorry. Oh. Okay. And then my cost of goods sold would be that 15,510 Okay. So now I'm just going to write those down just for my notes for question B. So I'm going to say FIFO cost of goods sold was how much? 12,934. My ending inventory was 2576. LIFO cost of goods sold was 13,210 and 2,300, and weighted average unit $24.77, $13.33. Okay. That's part A, that's question A. And here goes question B. Calculate the gross profit, correct? Gross profit is sales minus your cost of goods sold equals your gross profit. How do I calculate sales? Sales is units sold. Is units sold times exact times the what? No, but the sale price. Okay, so this is where we distinguish between the price that we sell it for and the cost that we paid for it. Okay, so how many units did we sell? 121. And how much did we sell them for? $170 per unit. So you do 170 times 121, and we end up with 20,570. Okay. So this is our gross profit. We're going to go for FIFO, for LIFO, and for weighted average unit cost. Alright. Our sales, no matter which method, FIFO, LIFO, weighted average, will be the same. 20,570. 20,570. Okay. The cost of goods sold for FIFO, we have 12,934. We subtract the 2 and we end up with 76.36 for that. Okay? We're doing LIFO, we do 13,210. Okay? And then we do weighted average unit. We have a cost of goods sold of, oops, I got these two mixed up. Okay, of 13033. And that will give us okay. Any questions about parts A or B, whether calculating your ending inventory or cost of goods sold or determining your gross profit?
So, did we already find out which one results in the highest net?
No, not yet. Okay? So now that we're at C. Okay? So it says C, which method results in the highest net income? The assumption is that operating expenses are going to be the same no matter what. So if I have gross profit of 76, 36, 73, 60, and 75, 37, then it's just simply whichever one results in the highest gross profit is going to be the one that results in the highest net income. We assume that operating expenses will be the same no matter what method we use. So which one gives us the highest gross profit is the one that results in the highest net income. In this case, it is FIFO. Okay? So here is our answer here. Highest gross profit, right? All right. Then question D. Which method results in a larger amount reported for inventory on the balance sheet? Okay? Well, now we're going to compare these numbers over here, ending inventory. So we said FIFO is going to give us the highest gross profit. And then when we compare their ending inventories, which one gives me the highest number? FIFO. FIFO, in times of rising prices, what does that mean? It's going up. 100, 106, 110, 112, 113, 115. Numbers are rising. Okay? FIFO will give you the highest gross profit as well as the highest ending inventory. They work together. Whichever one gives you the highest gross profit will give you the highest ending inventory. Whichever one gives you the lowest gross profit will give you the lower ending inventory. Okay? Any questions on that first part, chapter 7? Everybody got it? Okay, so it's one way or the other method is what it is. When you're doing FIFO or LIFO, we usually say let's start at doing ending inventory first because it's easier to account for those number of units. All you're doing is taking your ending inventory and comparing it to either your most recent or your earliest purchase and moving on from there. Okay? All right. Chapter 8, question 1. At December 31st, 2015, Dallas Company had a balance of $400,000 in accounts receivable and $25,000 in the allowance for doubtful accounts. Does everybody have this written down? Okay, boss, you got it? Peach shirt, you got it? Yeah. All right. So now this is, what kind of problem is this? Allowance for doubtful accounts? All right, so what are the two methods for recording bad debt expense? Who knows? Who can tell me? That wasn't even my question. I said, what are the two methods for recording bad debt expense?
Allowance method?
The allowance method is one. What is the other? Okay, it's the aging method and the percent of sales method. So when we're talking about those two, that's allowance and write-off. We don't care about that. The two methods we care about for this bad debt expense, for recording that, is percent of sales or the aging of the accounts receivable. So you read and it tells us we had an allowance for this much, Dallas wrote off that much, we recovered that much later, and then an aging schedule indicated that the balance in the allowance for doubtful should be 32,000. So what they use is they use the aging of accounts receivable method. Okay? So what happens is we have accounts receivable, correct? And we have the allowance for doubtful accounts. Those two together give me that net receivables. So here they tell us we had a $400,000 in accounts receivable. And it tells us it has a $25,000 balance in the allowance for doubtful accounts. If it doesn't tell you whether the account is debit or credit, or the balance is debit or credit, how do you know which one it is? Well, it's a normal. Go ahead. All right, it's a normal balance, and the normal balance of an allowance of a contra asset is always going to be a credit. So you know that this is here basically to reduce the accounts receivable, so you know it should go on the credit side. Okay? It will generally say if it's a debit balance that it has a debit balance. So A, prepare journal entries to record the write-off and to record the recovery of $3,000. Okay? So we want to record the write-off of $22,200. Okay? A write-off is just as simple. I'm removing it from my accounts receivable, and I'm removing it from being an allowance. Okay? So to remove it from an allowance, I have to do a debit for allowance. Okay? And to remove it from my accounts receivable, I credit accounts receivable. Okay? How much am I crediting and debiting? $22,200. Okay? At this time, I can come over here and I can still do this now. $22,200. What's my total now? $22,200. What's my total now? Alright. Then it says, rewrite it off, and we want to record the recovery of $3,000. Okay? So here at this point I have what? $2,800? Okay. So now I want to record the recovery of $3,000. Well, how do I start with the recording of the recovery? What's the first thing I have to do? Say what? I have to recognize that they still owe me the money. So that's accounts receivable. Okay, basically this is my write-off. I'm reversing that write-off. I just did the write-off for all that money that I wasn't going to collect, and now somebody said they're going to give me some of it back. So I just did the write-off. I'm going to reverse the write-off for the amount I expect to receive. And how much is that? Okay, 3,000. All right. Not 30,000, just 3,000. Okay. So now my allowance account, just like my accounts receivable. Oh, I'm sorry, this is going to be this side. And this will be on this side. Okay, so now I have a balance of how much here? 5,800, correct? Okay. Oh, we're going to record the recovery of $3,000, so we recovered this money. So then what's the next thing we must do? Collecting the cash, right. We actually received that cash, so that's cash. And then that accounts receivable. Okay. All right. Hold on. I got an itch. I need to scratch. Okay. So now are we done with that? So now we have to record the December 31st adjusting entry. Yes, sir.
I was going to ask, for the T-chart, for the AFBA, you put everything on the right, that means credit. Right?
Credit means right. In accounting, Credit means right, debit means left. When you see a journal entry, when I have a debit, whatever it is, I put it on the left side of my T account. When I have a credit, I put it on the right side. That's how I know what to do and follow those rules. Okay? So that's where we're at. We say now we have to record the December 31st adjusting entry for bad debts. What is the journal entry for bad debt? For the adjusting entry, it's always the same thing. What's the debit? What's the credit? Bad debt expense is the debit. Always, will never change. And the credit? Allowance for doubtful accounts. This will never change. As long as you're using the allowance method. Okay, and that's the one that they're teaching you in your book. Okay. It says an aging schedule indicated that the balance should be $32,000. Does that mean that I need to make a $32,000 adjustment here? Yes or no? Yes or no? Does that mean I make an adjustment for $32,000? No. Okay? It tells me that my balance should be $32,000. Okay? If my balance should be $32,000 and I have a $5,800 credit balance, then I need to subtract those two. And that difference is the amount that goes here for the account, or for the adjustment. $26,200. Okay?
Where do we get the 5,800 from?
We get the 5,800 because we started out with our allowance for doubtful accounts at 25,000. That's line 1. And then it tells us we wrote off 22,200, which is that part right there. So that's that first journal entry. After we wrote off 22,200, we then recognized the recovery of 3,000. So that required us to put 3,000 back. So when we go from 25,000 to minus 22,200, that leaves us at 2,800 for doing the write-off. After the write-off, we did the recovery of 3,000. So 2,800 plus 3,000 leaves us at 5,800. From there, it tells us that we updated, and our new adjustment says we should have 32,000 as a credit for our allowance. So we go from 5,800 to 32,000 by crediting it for 26,200.
So somebody just had a typo on the solution.
For the solutions, yes.
Yeah.
Yes.
Wait, where is the typo?
On the solutions, it should be 26,200 bad debt expense and allowance for doubtful accounts. What's up?
For A,
Yes, sir.
why do we do the second part? Like, why do we?
This one?
Yeah, 3,000.
Because they told us we recovered the cash. So if they recovered, then we must have collected.
Okay, so we're supposed to receive 25,000 and then
Excuse me? Where do you get 25,000?
just starting.
Okay, at December 31st, the company had a balance of $400,000 in accounts receivable and $25,000 in the allowance for doubtful accounts. It's saying at the end of December, we were owed $400,000 and we expected not to receive $25,000 of that. Then it says during 2016 we wrote off $22,000. So out of that $400,000, we're not even going to expect this $22,200. So that is linked directly to your after right there. If I had $22,000 here that I'm getting rid of, I've got $22,000 here that I'm getting rid of. Boom. Okay, then we say somebody called us up and said they're going to pay us $3,000. Once that happens, we're going to just put it right back. This was to take it off, we're putting it right back. And we're doing the collection. Okay? It does not affect our allowance for doubtful accounts, the collection, because we do that adjustment at the end of a period anyway. We're just going back to put it in there to be as part of that accounts receivable that we're collecting. It's just the process of what we did with the account. Once it went to uncollectible, we put all that $3,000 in there. So when we get rid of it, all that $3,000 goes with it. When we bring it back, all that $3,000 comes with it. Okay?
So
Yes, sir.
if we received the 3,000. Why are we still like crediting for the 5,800?
Who? Where?
Like we're subtracting 5,800 from the 32,000.
Now you're saying that has nothing to do with the 3,000 there.
Okay.
Okay, those are different separate events. So what we're saying is, at some point we collected, okay, so at the beginning of the year, right, at the end of December 31st, so beginning of 2016, we were not going to expect to collect 25,000.
Yeah.
Okay, we had any number of things happen. And at the end of this year, we expect not to collect 32,000. Is basically how it went. So we had 25,000, and then we said we're going to write off a lot. We wrote off some of it, then we're going to collect back some of it. That's that 3,000. Okay, we just collect. So what happens there is, like I said, because we brought this account back, we have to bring that allowance back. What ends up happening, what you don't see, is that gets end up being ignored on the next adjustment. Rather than this being 35,000, like if they would have still owed us, it's 32,000. But that's done behind the scenes. We don't care for you to care to know about that. You just need to know the process of we had a previous balance up there, okay? They read and tell us already. It's going to be adjusted. Our new balance should be this much amount. They just want you to be knowledgeable enough to say, okay, well, if I have a credit balance and I need to get to this credit balance, I subtract the two and do that. If I had a debit balance and I needed to get to this credit balance, I add the two and that's that. You just have to be comfortable and familiar with the process so that you know that once we do all these journal entries, I just go through this, add them up, whatever I'm at here. Then if they tell me that they want it to be 30,000, then I just subtract or add the two. Okay? It's like all that, the process is I took it off my books. If I took it off and then they told me I'm going to recover it, I'm putting it back on. I put it back on, I recover it. I recover it, now I need to make my adjustments for the next year. This is all stuff that happened in 2016. This is the very end of 2016. So all this stuff happened. This happened in January. I wrote it off. Some guy calls me in February and says, hey, I can pay you back with my income tax. Okay, I collect this in March. Great. At the end of the year, I make that adjustment that I'm making here. Got it? It's just mostly, can you put up this allowance, make these journal entries, and then come out and calculate that amount if need be. Any other questions about the bad debts? Okay. Just make sure you remember whenever you're doing the journal, the adjusting entry, this is that adjusting entry. That is the adjusting entry for bad debts. Okay? All right. Chapter 8, question 2. We loan $20,000 cash to Susie Tackham on a 9-month, 10% note. We want to journalize the original, do the adjusting entry, and then journalize the collection of the payment and the interest. Oh. Okay. Ordonez Supply Company loaned $20,000 cash to Susie Tackham on a 9-month 10% note. The hardest part is being able to count the months. Okay? The way I try to do it is I do the timeline and I tell myself to just put the first of the month in everywhere. Everywhere I'm going to see the first, that's a month for me. So here I start off November 1st. And then they want us to journalize the November 1st transaction. Here, which says we loan $20,000, right? Okay, if I loan $20,000, that means my cash goes down, correct? So that means I'm going to credit cash, and I'm giving a loan out, so that's going to be a note receivable. So that's money that I will get back later. Okay? And that's going to be $20,000 and $20,000. Okay? Now, from there, it wants us to journalize the adjusting entry for December 31st. So this is A. All right. Okay, this is where it gets confusing, where people want to say it's only been 1 month, it's been 2 months, it's been 3 months. Okay, as I say, just go ahead and put in every first of the month. From here to here, that's 1 month, and from here to here, that's another month. So in all, it's been 2 months. Okay? All right. So now, what is the formula for calculating the amount of interest? Well, what's the formula? What's our interest formula? Interest equals PRT? It's in your book. Yeah. It's in your book. All right, so we're doing interest equals PRT. This is how you get this calculation for your interest receivable. How do I know that it's interest receivable and not cash? Because it tells us adjusting entry. Adjusting entry, there's no cash. You're just recognizing the revenue in that period.
I'm in class right now, but can I grab a review sheet? Thank you.
Mm-hmm. Yes, sir. Okay. So in order to do the calculation for this amount that we're going to do this adjusting entry for, we say our interest is our principal, $20,000. What is our interest rate? 10%. Okay. And what is our time?
9 months.
November 1st to December 31st is how long? Okay, so our time is how much? 2 months out of? Which one? 2 months out of 12. Every interest rate, okay, is given to you as an annual rate. So every time you're calculating the months, however months has passed, out of 12. Yes, sir. Yeah, because I'm using the timeline. So I'm using a timeline. That's for 1231. Mm-hmm. It would, yeah. If I'm just writing on a sheet of paper, I would write it down. But I'm trying to illustrate it on a timeline to say, this is how much we're recording in this period. So we've gone 2 months from November 1st to December 31st. So I do that calculation and I get some number. 333? 200 times 10%, or 20,000 times 10% is 2,000. 2,000 divided by 12, I guess, is 167 or 166.67, and double that, and that's where they get our 333. Okay? So our interest receivable at this point is $333. All right. Journalize the collection of the payment for interest and the note at maturity on August 1st, 2016. So we are going all the way here to August 1st. So how many days or how many months have passed from December 31st until August 1st? Who's got an answer? 7. How did you calculate it? 9 minus 2. If they told me that we have a 9-month note and we are at the maturity date, I've already recorded 2 months, and this is 9 months altogether, then I just simply say 9 minus 2 is 7. Okay? So our interest is going to be that 20,000 times 10% times 7 over 12. Okay? So here we're going to have 2 journal entries. 1 journal entry for the interest, 1 journal entry for the repayment of the note. Okay? So at this point we should be receiving cash. This one is to record the interest as well as that receivable. And the rest will be considered revenue. How much interest is receivable? $333. Just the amount that we put before. Okay. How much are we to receive back altogether? 20,000 times 10% times how much? This number right here, right? So what does this number right here represent? Does this represent the cash or the interest revenue? It represents the interest revenue. This is your interest revenue. Revenue for which year, right? So this is all right, that's the revenue for 2016. That's the revenue for 2015, all right? Altogether, we're going to get how much cash? $1,500. Okay? That's generally what it is. And the payment of the note. So that's that one. This repayment of the note is just a reversal of this one before. So before it was note receivable cash. Now it is going to be cash, note receivable. Any questions on A, B, or C for number 8? Question 2. Yes, sir.
Just the last thing that you did, 20,000 to 20,000, is that like a different one, or you put that underneath that one?
Okay, so no, this is the 2 parts. So here I loaned out $20,000. Okay, at the end of the year I have to recognize what part of that $20,000 interest is for this year. Okay, at the end of this, they're going to pay me back. They're going to pay me back the $20,000. That's where I'm getting cash now, no receivable. So they're going to pay me back and I'm going to close it out. And they're going to pay me the interest they owed me. $1,500 of that $333 from last year, and now the rest of that is this year's revenue. So what this is doing is closing out. They don't owe me the $20,000 anymore. This is, I gave up my $20,000. They owe me $20,000. Okay, They paid me back. They don't owe me anymore.
So as of right here, this is at like January 1st or December 31st?
This is January 1st,
Yeah.
right? So this one is,
Cash of $1,500.
this one is August 1st. This is the end of the loan.
Okay, why is one receivable and one with revenue?
Okay, because let's go back here. Let's go back here. I loan you some money.
Yeah.
Okay, you promised me you will give me money on top of what I loan you.
Yeah.
Okay, I'm going to loan you $20,000. You're going to give me back $20,000 and $1,500 as well.
Yeah.
Okay, that $1,500 that you've given me is for a period of how many months that I loaned you the money? 9 months. These 9 months that I loaned you the money, in order for giving you that money, I earned how much money? $1,500. The $20,000 is already mine. So over these 9 months, I have $1,500 that I've earned. How much of that $1,500 was earned in the first month? In the second month?
333.
In the first 2 months, I earned 333.
Yeah.
So this 333, at this point, I have to record that as revenue at the end of the year.
Yeah.
So that last year, that 333, that's just from 2015, whereas the rest of it, of this 1,500, is from 2016. All it is
So it should be the opposite? Or,
what should be the opposite?
You finish what you were saying.
Okay, so what happens is at the end of the year, I've given you out $20,000. When are you going to pay me back?
August 1st.
August 1st. You're going to pay me back August 1st. But at the end of the year, 8 months before this, or however many months before this, 7 months before,
Yeah.
I have to recognize the revenue. I have to say that for these past 2 months, $20,000 that I loaned out has earned me $300.
Yeah.
Okay, because I had to do this, okay, my money that I'm getting, this $1,500, is split up into 2015 and 2016. In 2015, this is 333. In 2016, this is 1167. So when I receive my $1,500, I have to recognize that 333 I was receiving from last year, whereas this 1167 is my revenue for this year. Okay? Any other questions? What's up?
The problem I have is you see how you got the 7 out of 12?
Mm-hmm.
I'll mistakenly add up from November to August and fit 9.
Okay, so if I come out with I equals PRT and I accidentally use my 9 out of 12, what do I end up with? How much is that? How much am I going to have to get back? Hold on, whoa. Stop the calculators. Stop the calculators. How much am I supposed to get back at the end of 9 months? 1,500. So if I do the full term, and I do it for the full amount, for the full period, the 9 months that the note was issued, when I come out with this number that I come out with is my cash amount. See, you have to just understand which ones you're coming out with, then it's not a big deal. Because if I come here and I did this one already, like if we did the 2 months, fine, perfect, boom, I got it. I know then in my next journal entry, it's going to be this. As long as I've done this one, I know that the next journal entry is going to look like that. Cash, the interest that I was owed, and the interest that I'm going to get for the next period. So you just have to keep in mind which one goes where. So if you do that, and this is all you have to remember, if you do that and use that full number, that just goes in your cash amount. That's just how much you're getting paid at the end of the note. It's no other trick to it. It's just recognizing that even if you use that 9 out of 12, it's still telling you some info you can use. Okay? If you wanted to do that, come out with that and say, well, that's for the full. I already did the first part. I can do that 1,500 minus what I came out with before and do that. This is accounting. This is more than one way to skin this cat. The only thing you want to make sure is you know these rules, you know these journal entries. Journal entries never change. At this point, you should be comfortable with them, and it's these calculations that you just have to be getting down. Journal entries are always going to be what they are once they say this is what it is for this. Yes, sir. Practice them.
I'm talking about like memorizing, not memorizing the terms, but how like for interest revenue, like interest receivable and interest revenue. How could those both be credited? How are those both or debited?
How are they both being credited here?
Yeah.
Okay, so what's happening here is this is when I opened it. So here's when I started saying, well, for this period, I earned $333. So part of it is it's a step-by-step asking yourself what's going on in the transaction. You have to keep that mental questioning going on. Okay, so when I'm at 8-1, and here's two parts of it. You have to know these journal entries. It's not about how do I know that interest receivable is getting credit. Once I memorize that journal entry, it's not even, so what you're doing is you're questioning why, because you're not sure on the journal entry. When I'm telling you that this journal entry is very rarely going to change. The only way that this journal entry changes is if they receive money at the end of this year or something like that. But the book hasn't taught you that, correct? So the book cannot expect you to know to do that if it hasn't taught you. The book taught you 4 specific journal entries. When I establish the note, when I record my revenue at the end of the period, and then when I receive my cash. These are the 3 transactions we're dealing with. How it's going to go is every time at the end of a period, I'm going to have to record my receivable and my revenue. It's an adjusting entry. That's from chapter 4, adjustments. Anytime we've got revenue that has not been collected, accrued revenue, we're going to open up a receivable, interest receivable, and interest revenue. So that's just pretty much practicing a previous chapter. And then all it is here's the payment. You know, it's going to be this, and you just want to make sure you're comfortable with that. With that. Once you know this one, you know that when you come do this journal entry, it's that same number. Once I did this calculation, I know when I'm coming to this one, I have that interest receivable because it comes directly from that one. And that's pretty much what it is. I know this one goes there, so I know this goes there. I know I'm supposed to get all the cash so I can do this, and if I do this minus that, I get that. There's a number of ways you can, sit down. You don't have to do it's been 7 months again. No, you can do it just like he did. Well, I already recorded my 2 months. I know that's 333. Well, at 9 months, let me say I'm supposed to get 1,500. That 1,500, 333 was from last year. That's the rest. Okay? So, you want to make sure you know those journal entries just so.
Also, another tip of that is my teacher did tell me that it was going to be all multiple choice. So, obviously, there's going to be this type of work to do it, but the answers that are multiple choice, is it just these same answers, just a multiple choice?
They can ask you that, when it's all multiple choice, they can ask you questions, but the ways they can ask you accounting questions is so many different ways. How does how does the adjusting entry for interest at the end of the year affect your balance sheet, affect your income statement? That type of thing. How is increase? You loaned out $20,000, 9 month 10% loan on November 1st. What is the interest revenue you have to record at the end of 2015? What is the interest revenue you have to record at the end of 2016? That type of thing. So one would be that one, the next would be So they can ask you, I don't know what they'd ask you.
No, no problem.
But they can still ask you the same, they can't ask you what's that amount. They just, give you the 4 different options for
Yeah,
it.
and then you can just solve it yourself.
Mm-hmm. Mm-hmm.
We'll just make sure.
Mm-hmm. Any other questions on this chapter 8 stuff, the loans, note receivables, et cetera, et cetera? Okay, everybody ready for this depreciation expense? All right. All right, depreciation expense. All right. They taught us 3 different depreciation methods. You would like to make sure you are familiar with them. Okay, 2 of them are very much similar. And 1 is just way out there wonky. I'm not going to say things. Okay, it's just a little different. So we have these first 2 that we teach. Okay, so we bought a new machine at a cost of $120,000. It's going to have a salvage value or residual value, that's the same thing, of $12,000. It's going to be used for 10,000 hours, or it's 5 years. So they want us to use all the different depreciation methods, right? Pretty much. The machine calculated using straight line, double declining balance, and units of production. Okay. What is this straight line formula? Uh-huh. All right. Cost minus residual or salvage value. Okay. Over the useful life. Okay. Another way to look at that is cost minus residual value times 1 over the useful life. Same. These are the same. Okay? Whichever way you want to look at it. Okay? Then you have the units of production. Units of production, just like the straight line, says cost minus residual value, right? And then this time we say, instead of 1 over useful life, we're going to use hours used over total estimated life in hours. Okay. And then, what's the formula for double declining balance?
Cost minus residual value.
Cost minus what?
Residual value.
Cost minus what?
Isn't it the book?
It's the book value. That's how I remember it. I don't even use cost minus. I use book value. Why do I use book value? Because these 2 are so easily the same. Cost minus residual value. Cost minus residual value. That if I went in there and I did the next cost minus, I'm already thinking residual value. Right? Yeah. It's already on my mind. I use the term book value. It's the same thing about what we really want to say. And it's this. Okay? Cost minus your accumulated depreciation. That's what your book value is. Your cost, however much it cost you, minus however much you took away from it already. Okay? So it's book value times 2 over useful life. Okay? So it's cost minus your accumulated depreciation times 2 over your useful life. What do you have to make sure and you remember about double declining balance?
Doesn't go below it.
Do not depreciate below less than your salvage value. That is the big star. Do not depreciate your to below book value. Okay. Are you ready to go through each one of these and figure out how much it is? Okay. Compute depreciation expense and also calculate the book value at the end of year 2 after depreciation has been recorded. So they give us a neat little worksheet or depreciation schedule on homework, something that says something like cost, or it might even be depreciation expense, cost, accumulated depreciation, and book value, right? Okay? So the cost of the machine is how much? $120,000. Will not change. Cost is the cost. Okay? Now we want to calculate our depreciation expense. It is just this. Our cost of how much? $120,000 minus our residual value. Our residual value tells us it's the same as our salvage value. So that is $12,000. $120,000 minus $12,000 divided by useful life of how much? 5 years. Okay, 5 years. So that is 108,000 over 5, which is 21,600. Okay. Depreciation, straight line. What do we know about straight line depreciation? It's the same year after year after year. That depreciation expense will just be 21,600. 2, 3, 4, 5. What do I know about the book value at year 5? It's going to be how much?
120,000.
No, that's the cost. Cost will always stay the same. But once I've finished depreciating it, it's going to be 12,000. My book value. You get that? This is what straight line is. Straight line is says, I bought it for this much. It's going to be this much, worth this much when I'm done for it. So I take out that amount year after year after year. If I take out that amount year after year after year, I'm going to go from here to here at the end of 5 years. So at the end of 5 years, you should have that book value. Okay? So you can add up to this for all these accumulated depreciations. Not very important. They're access to do what? If the machine was purchased on January 1st, calculate depreciation expense for 2015. So this is 2015, 2016. Right? As well as the book value. Yeah, and calculate the book value. So I say this, 120 minus 21.6, that's 43.2. 120,000 minus 43.2 is something with an 8. 120 minus 43, or 119 minus 43, 6, 11 minus 9, 76, 800. Is that what somebody got with a calculator? Okay. Everybody understand how I got that? Yes or no? So what happened is accumulated depreciation. Accumulated depreciation. Okay? How many miles did you run before you started running? None, right? Once you buy a machine, the amount that you've accumulated, depreciation is 0. After that first year, you've got that much. After that second year, all you're doing is adding a year. That's what accumulated depreciation is. Okay? And that's how I get people to think about it. How many miles did you run before you started running? You didn't. Doesn't matter if you planned on running beforehand. Doesn't matter if you had an old idea of running. Doesn't matter if you bought an old machine or whatever. When you first buy it, you have not depreciated it. Okay? All right. So that is straight line. Now we have to do units of production. Units of production is still this 108,000, right? So 2015 depreciation expense. All right? It's still now 108,000. Everybody know where I got this 108,000 from? I just said cost minus residual value. I've already done it over here. I'm not going to waste my time and do it again. Okay. So I have 108,000 times the hours used divided by the total hours. So the hours used in 2015 is 700 with an estimated total life of how much? 10,000 working hours. 10,000 working hours. Okay? 2016 depreciation expense 108,000 times, what did it say, 750? 750 out of 10,000. Okay? Who's got those numbers for me?
Oh, the depreciation expense.
For the depreciation expense 2015.
2015 is gonna be 7,560.
7560. For 2016, 8,100. Okay? When I add these two up, that gives me the accumulated depreciation for 2016. I subtract that from my cost, and that gives me the book value for 2016 using that method. 0, 6, 6, 15,660. I have 120,000, so my book value cost less accumulated depreciation. Mm. 104,340.
So, you got, what is this 15,600?
That is my accumulated depreciation as of 2016. Okay, how did I get that? What is my accumulated depreciation? It's all my depreciation added up. 2015 depreciation plus my 2016 depreciation. All of it added up, and that gives me my 15,660. Okay? Okay, and the bit of a runner. So we say we've still got depreciation expense, cost, accumulated depreciation, and book value. Okay. We know that the formula is book value times 2 over the useful life. Well, when you first buy it, your book value equals the cost. Okay? So your book value is 120,000. 120,000 times 2 divided by 5 is what? 48,000? 48,000. Does everybody, hold on, let me just go ahead and say the 2015. Okay, so in 2015 we had depreciation expense of 48,000. Gives us accumulated depreciation of 48,000, which gives us a book value of, I'm sorry, 72? 72,000. Okay? So now 2016. Depreciation expense. Okay? I'm just going to use the book value because I'm using this worksheet to come up with it. Book value is 72,000 times 2 over 5. So this is 144 over 5, which gives me some number. Is it 28,800? I think it is. Wait. Yep, 28,800. Okay? Do we have any questions? Any questions on how I'm getting these numbers? Because this is probably the most confusing one.
Everything at the top that you're doing with the depreciation expense, 2015 to 16, that's just plugging in numbers right from that graph.
What I'm doing is, yes, I'm using this. So what I'm using, how I'm doing this table, is I'm starting off with when I bought it. I know all that is going to be 0. I'm using the book value, which is how much it cost. Cost times 2 over 5, or 2 over useful life. I do that. I bring that down to get my next accumulated, so that's my accumulated depreciation. Subtract that from that book value to get, 120 minus that to get my new book value. Use that new book value and come out with the new, new 2016 book value, and then continue on. That's basically the process. Being comfortable with the process of being able to say, okay, this is the cost when I got it. Cost times 2 over useful life. Okay, that's my depreciation expense. Now I subtract that from that cost. That's my new book value. Going through that process. Okay?
So how did you get the balance and accumulated?
These, for 2016, I'm adding these up. 48,000 plus 28,800. Okay? So this is just every year added up. Was that 48,000 plus 28,800?
So for the book value would be what to calculate accumulated depreciation, it would be
To calculate which? Accumulated depreciation? It's all your depreciation expense. So.
like why do you add the 48,000 from 2016 to the book value of
Forrest Gump has been running for 10 years. Last year, Forrest ran 5 miles. This year, Forrest ran 10 miles. How many miles has Forrest ran? 15, right? Accumulated depreciation is just saying, how much have I done over this entire period? So, if we go out here and we say, last year we depreciated it 48,000. This year we depreciated it 28,800. How much did we depreciate altogether? That's what accumulated depreciation is. That's the answer to that question. How much did we accumulate? How much did we depreciate altogether? That's our accumulated depreciation. So you get accumulated depreciation just by going to your years of depreciation expense and adding them all up. Quickest way. Don't have to do any more. I just go here and I add up until I have no more depreciation expense. That's it. That's it. That's all you're saying. This plus this, give me that. That's it. Okay? This plus this, and that's each year. Okay? If I had to do one year, 2 next year, 3 next year, then I say 1 plus 2 plus 3, 6 altogether. Accumulated depreciation is just adding up your depreciation. Okay? Any questions on anything from any of these chapters that you might not have heard here, you might have questions on, you might want me to make sure I just go over again and try over for you guys?